Right, hello. Today we are going to be discussing capital structure. All right, so we're going to introduce you to this notion of capital structure. And capital structure is one of those things that is very difficult to comprehend. It's a one of those things that it has a number of stumbling blocks until you kind of understand it. But basically what we're looking at here is that this is one of the major responsibilities of the CFO in an organization. Okay. Now, we refer to the CFO as being the second most important company behind the CEO at a company. The CFO is typically going to be a more important person in a company than the COO or the CTO, right? The people that are actually making the product. And the reason being is that the CFO is in control of this fancy notion of the capital structure. Okay. Now, what capital structure is it is a combination of equity to debt. Now, this might not seem like it's a very difficult concept, right? Is that, all right, I borrow some, I sell some stock to some others, but it's actually is a very difficult concept, okay? It's a very important concept, okay? I'm going to start this off by looking at this on a graph, okay? Now, on this graph is that what we're going to have here is that on our vertical axis, we're going to have firm value, okay, so how much the current company is worth. And on our horizontal axis, we're going to put our debt to assets ratio, okay? And so we refer to this as leverage, okay? And so our question here is, how leveraged do we want to be, okay? Should we finance ourselves through using debt? Should we finance ourselves through using equity? Okay. Now, we know if we have zero debt, okay, so our debt to assets ratio, it cannot exceed 1, okay? So we're going to have 1 is that cap. And then we have our firm value. So we can have a firm with zero debt, okay? That is possible to have a firm with zero debt. And so that is going to give us our x-axis here. And so this is a zero debt, right? And we're also along the horizontal axis, zero debt, okay? Now, what we do is that when we can take on more debt is that we can then leverage ourselves, okay? And what we do when we're leveraging ourselves is that we have an increasing firm value, okay? So as we take on more debt, we're able to leverage ourselves more and we can increase the value of our firm. So we have here along our horizontal axis is that as we take on more debt is that we can increase our firm value, right? Because we're taking on more debt, we are able to go and do bigger projects that are generating higher returns, okay? However, this upward sloping line here, that does not incorporate one of the major factors within borrowing more, which is bankruptcy, right? You borrow more. If you have a 100% of your assets are financed by debt, you are incredibly leveraged, there's zero owner's equity, it's going to be, there's a chance that you could, fall off and not make as much, okay? So the CFO's job here is to using the financial assets and financial tools is figuring out exactly what will give us the highest firm value, what is going to generate the highest shareholder return, okay? So what we have here is that we have another curve, which this curve here incorporates the difference here, which is this difference right here, are bankruptcy costs. Okay. And what we know is that at low levels down here, right, in this area right here, there is a extremely low bankruptcy costs, right? At those low levels, there's a small chance a very slim chance that we're going bankruptcy just because of the leverage. Okay. However, once we reach into the higher levels of leverage, so those bankruptcy costs start to tail off a bit. Okay. So what we have is that we have this point here. If I am a company, so this curve right here, this is the one that we are actually facing as a company, okay? This is the one that the company is actually facing because those bankruptcy costs do take away from firm value. Since we are trying to maximize our firm value, we're going to go over to the place along that curve here, so where we have the maximum firm value, okay? And we're going to put that as a star, right? That is the highest point of firm value. Okay, and so we follow down this way, and we have our debt to assets ratio starred. And when we use stars, that means that is our optimal level. Okay, so we have an optimal level of debt to assets ratio. Okay, so that is our optimal level, and that maximizes our firm value, which maximizes our return to our shareholders. Okay, so the question here, though, is what if I have more projects that need to get done, right? And if I borrow more, I have increased bankruptcy costs. Well, simply, we then go sell equity right? We sell equity out to investors. We sell stock to investors, and that will help fund our other projects, okay? And then as we sell more equity, that's going to change the amount of assets that we have, and the CFO has to manipulate and has to work this out and has to figure out exactly what that optimal level of debt to assets ratio is. Okay?